welcome to Western Wealth Capital. I'm certainly not the one who will be doing all the talking today. My name's Eric. I'm our Chief Revenue Officer here at NEO. I'd like to introduce you to Mark Breakspear, VP of Fund Operations, and Doug Mather, EVP, both from Western Wealth Capital. Mark, Doug, welcome, and thanks very much for joining us today.
Thanks for having us.
Thank you.
My pleasure. My pleasure. Let's get a few quick things out of the way. We've heard of you before. You both recently joined us on a CASA panel last week. Actually, Mark, that was just for you, but perhaps some of our audience have not. Your newest addition, or our newest addition to our distribution capabilities include your OM funds, now available on Deal Square. Ticker is WWCUS. To start us off, why don't you give us a bit of a view on yourselves and Western Wealth Capital? Mark, maybe start with you.
Sure, happy to. I've been around this investment industry for a while now. Got started back in 2002. Primarily been on the dealer side of things, and then switched over to more of a product issuer side in the last year or so. Just been with Western Wealth now close to a year, helping get the funds business started here and really capitalizing on what we've done in the past in a new packaged form. So that's really what I do with Western Wealth Capital.
Excellent. Thank you, Doug.
Yes, I've been with the company now 5 years. I oversee acquisitions, dispositions, and financings. Previous life, I was with a top tier Vancouver developer that for 11 years in their finance role, and that set me up nicely for what we do here at Western Wealth.
Brilliant. And then Western Wealth Capital itself, a firm focused on U.S. Real assets. Maybe look to you both for a very short primer on the organization, focus, capabilities before we kind of get into the mandate itself.
Sure, I'll take that one, Mark. 8 years young, our company. I keep saying young, but 8 years is starting to get old as a company. Started our footings in Phoenix. We've got a strong foothold there. We have a second office there from our head office here in Vancouver. We are currently the second largest apartment owner in Phoenix. That allowed us to put that footprint in the U.S. in these, I call them everyone calls them the smile states, the states that are experiencing huge growth in terms of population, job growth, and so forth. And then we've branched out from there into a few other states, Nevada, Georgia, and Texas. And we continue to grow our footprint.
I love it. Arizona's probably got a bunch of ways to put smiles on your faces, not the least of which is perhaps the weather. But I like it. Now, as a firm, there's obviously a lot of competition, multifamily real estate sector. Doug, thinking about where you and the firm position, what makes you different from the others? Something that our audience might not necessarily know about you and the firm.
Sure. Well, in terms of our size, I guess starting there, we've acquired a little bit over $3.2 billion worth of real estate in this space. So what I mean by this space, I mean value add multifamily real estate. And there's really two things that differentiate us from other groups. The first being speed. So the day one, when we take over a property, we've got a 52-point checklist, which we keep adding to that checklist. It used to be 12 or 15 7 years ago. Now it's 52 and vastly growing. But day one, paint is going up on a wall. Day one, we're renovating 3 suites. Day one, we're engaging our tenants to ensure that they understand that there's a new manager in town, that we're going to make their lives better, and in return, we're gonna increase revenues as well at the same time. So that's number one. And doing that from our perspective minimizes risk. So if we waited to get on property day one and start looking at what we're going to do, we've just exposed our investors to risk. And if we can contract on risk in any way, speed is one way to do so. The other is just managing the gap. So my job, and my kids ask me what I do, and I say, I manage the gap. And the gap is the gap between us and the next level of real estate up. So the cost of replacement is one thing we look at extensively, and managing the gap between rents. We're looking for properties that are undermanaged, where we can capture that differentiation and the gap that our neighbors are charging versus what the property that we're acquiring is charging. So the more we can squeeze the gap, the better we do, the better our investors do.
I like it. And I think that 3 billion number is a pretty sizable milestone. Congrats. And I saw a couple of other numbers on your website as we were preparing for our discussion today. You know, 1 billion placed in PE. Obviously, it looks like a pretty credible track record in growing the number of assets that you acquire. You know, we've heard a bit about perhaps what makes you different. Maybe a good way also, Mark, to bring you into the fold on the conversation. You know, if I'm an advisor or I'm an investor in the crowd with us today, you know, how are you guys trying to position Western Wealth Capital's mandates into the fund, or Doug, perhaps that falls in your court as well? How do you kind of present yourself? How do you differentiate yourself, and where do you see that kind of fitment going from a fund perspective with investors?
Yeah, I'll start off with that, and then Doug, feel free to jump in and add. You know, beyond the fact that obviously every advisor needs to qualify each client based on their needs and their goals with KYC and so on, we really are a growth-oriented real estate play. We don't typically fall into the category of being income oriented. So it is a longer term hold, which a lot of advisors have then been using us sort of as a core product within a portfolio for clients. We're high growth and also longer in terms of our business cycle or our business plan for each property. We are typically 3 to 5 years in each asset. And the latest fund that we've just launched, for example, it's a 7-year closed fund. So it's really for that investor that's looking for higher than average growth over a sustained period of time. You know, one of the advantages that I see and that one of the things I've been hearing back from advisors is not being daily valuated like some of the other public style vehicles. Really, that's insulated a lot from public sentiment in terms of valuation. So the value really comes in the actual work that we do over a period of time. And so if a client's looking for less fluctuation and less movement in valuation, that's where we come in and still deliver on above average returns over time.
So in effect, you're looking for long-term investors in a business, a fundamental belief in the real estate business, in particular U.S. multifamily, and that's kind of your target audience when attracting money into the mandates.
Exactly.
I like it. You know, it's been pretty fascinating year, I think, as far as real estate goes, and you're maybe in the catbird seat at the moment, but before I kind of bias the crowd on it, you know, the 18 months of the pandemic have seen some pretty interesting swings, you know, as folks contemplate living situations, work situations, the whole work from home side of things. Maybe Doug, start with you. You know, 18 months of the pandemic, is this an opportunity for you and the Western Wealth Capital team? How's the firm kind of responded, reacted? Have you changed anything that you do as a result?
Sure. Yeah. Last year, April, we were all navel gazing and trying to determine exactly where we sat in the world and what was going to have the impact it was going to have on real estate. At the time, we spent a lot of hours agonizing over what strategies would hold us best in terms of our properties. Going back to the strategy of speed, I think by capturing that extra revenue early and quickly, most of our properties were in very good shape. But that said, there was a bit of a lull in the market. I would say April through June, and June 2020, real estate transactions started to happen more on the private side than on the public side. The public sector tends to be a little bit slower to make that move. On the private side, transactions started to happen, and we've had our best year to date in 2021, a little bit over 1.2 billion in acquisitions this year. And it's been a massive opportunity for us. So as you mentioned, people are looking at the same four walls that they go to home every day, or they work all day and they stay home in the evening. So they're happy to look for a nicer place to live, and that's what we try to afford: is a nicer place to live for a reasonable price. that looks like the A space, but maybe in the B space, or looks like the B space and in the C space. So that's managing that gap again, but ensuring that we give something that people want. And that's what we spend a lot of time on. In terms of going forward, I'm gonna jump into inflation here, and I think that's a topic that may come up at some point here. In an inflationary environment, real estate is always a good place to be. A physical asset, cost to replace. I don't know if anyone's tried to change an appliance today. But if you can find it, you're paying more for it. If you can find the labor, you're paying more for that. So the cost to replace any of these buildings going forward will cost a little bit more. And also going forward, we anticipate, and I think the market anticipates, income increases. They have to in order to catch up to the cost of materials and food, and so forth. So those two factors alone will position us very well going forward in terms of our existing assets as well as the assets we're acquiring.
Interesting. I'll make you chuckle for a small moment. Little sidebar. I've been waiting 18 months for a new dishwasher. So on the note of trying to upgrade or fix things, it is incredibly difficult to do so. And I've seen a few home renos move their way through the cost of lumber and some of those things that go into making a new home, certainly getting more expensive. So that the inflationary comment, bang on, and holding those assets already probably a smart move. What do you think the outlook looks in the kind of medium to long term? Once hopefully some of these things get put behind us, where do you see the opportunity for Western Wealth Capital and the fund itself?
Just jump in briefly. I mean, the core of our business thesis is we want to be where population growth is happening, and the markets that we operate in would all be, I believe, in the top 5 in terms of those major cities that are growing the quickest within the U.S. And a big part of that growth is happening because basically a lot of folks are moving from the Californias and the New Yorks into the markets that we operate. And their employers are recognizing that. And so they are making significant investment in facilities in those areas. And so that's bringing higher levels of income into the markets that we operate. And again, that's sort of the basis of the thesis. And we're seeing more and more of these types of announcements happening with Facebook or Meta or whoever we're calling them today, making recent bids and acquisitions of $800 million in Northern Texas. It's continuing to happen on a go-forward basis, and that just gives fuel to the fire of our ambitions. And where Doug has been around longer than I have, but when we used to see rent bumps based on the value that we're adding to a property in the neighborhood of $150 a door, we get daily activity reports from each of our properties, and we're seeing bumps of $400-$600 monthly, which just again accelerates the business plan in many respects. So when you talk about runway, the business thesis is very alive. The business plans are performing stronger in most cases than we had projected, and so I think we're in good shape. And one of the first questions I get from advisors is, "Hey, Mark, you've done so many buildings. How can you sustain? Like, are there that many buildings for you guys to acquire and add value to?" And I check in with Doug. We have a Wednesday morning call each week, and we talk about his pipeline. And the most recent number I heard from himself and Ashley O'Neill that he works with was 42 properties in the pipeline. So we're in a place where there's still lots of value to add and lots of runway in this segment. I don't know, Doug, if you have anything more to add there.
Yeah, it's actually, I think 51 today. I'm just looking at it in front of me right here.
We haven't checked in on it this week.
It's and it's not all will be the right investment. So we I don't know, we analyze a few hundred properties per year, and only a short list that makes it to a point where we are willing to bid. So a lot fall off the table. It starts off as an exploratory investigation, and then but all that being said, there's still plenty of opportunity in the market, and given the size of the markets and the growth markets we're going into, there will continue to be for quite a while.
I like it. And maybe a question on the relative topic to growth that came in from our audience. You're squarely focused on the U.S. market today. Any plans to expand geography, looking at Canada in particular from the audience, but any kind of future growth expansions outside of the US that are on your radar?
Nothing at this point. So just to give you some data points, right now for 2022, Phoenix is anticipated to grow by 1.6%. Texas is around 1.5%, and Dallas and Houston roughly the same, maybe slightly less. Vancouver's 0.97 of 1%. Toronto's 0.93 of 1%. Just to give you, it's not quite double, but significantly more growth. So when you have that migration happening, and you're typically migrating from a coastal higher income state, so there's wealth or relative wealth coming into a market, you're going to see those rent increases, like Mark mentioned, of $400, $500, $600. The other aspect of the U.S. versus Canada is the limitations on rent increases. So I believe the limitation on any rent increase in Vancouver for 2022 is taken off. You can now increase rents up to 1.5%. So that 1.5% does not equate to a material increase, and it doesn't actually keep up with inflation. So it's not to say that the Vancouver market and Toronto markets are not good investments, but they rely more on cap compression than on income growth for movement of value.
And as a philosophy for an investor, especially one looking for growth in capital investment, go where the growth is seems to be the staying point. I like that.
I think, Eric, as well, it's really important when an asset manager or an investment manager says, hey, here's what our mandate is, and they stick to that mandate. And in many respects, when I'm speaking with advisors, they bring up some of our competitors in the conversation, and I'm very quick to say they do a good job at what they do. We do something different. Either we're operating in different markets, or they work with more of a core product and we're more of a value add play. Having that niche of what you do being a differentiator from others really helps us work together in a real estate portfolio, and really help us earn our piece of that pie.
I like it. No, it makes sense. If you're good at something, stick to it. And if you've got a track record in doing it, build. And focusing on non-core initiatives, especially in markets that aren't growing at the same rate, you've got a niche there to focus on. Makes perfect sense. Mark, maybe this one's for you. And speaking about that bridge into advisors, the fun, as always, is in finding those pockets of investors and their financial advisors accordingly to come in and invest in the fund and help fuel the growth for Western Wealth Capital. You recently joined us to bring the fund on book and electronic with the ticker. It's a fascinating time working with dealers, advisors, and investors, I'm sure. Talk to us a little bit about the decision to join us on the platform, benefits, where you saw that discussion evolving with your dealer community, and why you made the move.
Yeah, I mean, initially, Eric, it was NEO wasn't well known to me. I had heard of it, didn't really understand where it sat in the industry, and we were in conversation with one of our main dealer supporters, and they were very quick to say, do you transact on NEO, because that's where we spend a lot of our time? And I'm like, tell me more about that. And the reason that these advisors in this firm in particular does is because they're chasing alternatives. They're looking for products kind of within this segment, and that is the go-to. So it just makes good business sense to be a part of a platform that promotes what you do. And so we kind of came by it that way. And then being a part of NEO has also solved a couple of back office problems for us. Things that being newer in the funds business, we just didn't have set up. And so it's really allowed us to create efficiencies within our clearing. And really, again, this is where our audience lives, is on a platform like this. And we've come to realize as we're moving from dealer to dealer through the due diligence process, there's more and more dealers that are actually transacting primarily with Neo and Deal Squared as a platform. So it just makes sense for us to live there as well.
It's encouraging to hear. It takes time to build a business, a bit similar journey to what you've been through. I think you hit on two pretty key points. Like, it's familiarity of a platform. You get a ticker. WWC US is the easiest way for our crowd to kind of come and find you today, and it shows up the same way any other listed security would, even though it's a private OM fund. Structure and Deal Square will take care of your paperwork, the whole e-signature process out to your clients. Everything becomes, and I think that's probably the most important part in this day and age, fully digital process. As long as everybody is prepared to embrace it, it removes the paper. I've even had a few fax machines come across the desk. It makes you laugh, but it's still there, and we're a part of this long-term investment cycle and building up these partnerships and bringing quality asset managers and their dealer partners to the table in a more efficient, cost-effective solution that just really solves for the advisor's issue in getting into alternative assets. I like it, and thanks for the color and confirmation. Thinking a little bit as well about where your conversations might be headed in the future, and I'll come back. I know there's a question in the question box. I'll come back to it in a second. As far as future plans, mission, vision, you've got the one fund out today. If you're forward looking out, another year, 2 years, where do you see that kind of mission and vision going for Western Wealth Capital? Do you see more funds on the radar? What's kind of your future forward looking view?
Yeah, I mean, we're a young-ish company, as Doug mentioned. 8 years isn't feeling as young anymore, but we're a very agile firm, and so we're always looking for the very best ways to gather capital and the best ways to deploy it and add value and all that along the process. And so we are now looking at a couple different funds as well that we're in the process, early days to launch. So this will not be our first or only. Well, this will be our first, but not our only. And we're always just looking for ways to create efficiencies within the business. It reminds me, just to depart for a second, during pandemic, for example, in that period, as Doug said, we kind of took a step back and thought about the business and how do we move the business into a place where we'll do better for our investors. So we decided to have sort of integrated control over the entire business. One of the things that we did during what would seem like an odd time is fully integrate property management into Western Wealth Capital. So Western Wealth Communities, our own property management firm, was born. We were relying on a lot of good partners, but third-party partners to execute on the assets within the firm, and we decided to internalize that and have that integrated control in order to make things happen a little bit quicker. As Doug said, speed matters in this business for us, and ensure things are being done in a quality and a very human way. And so we very much intend to keep doing things that way. As we see things that will work for us, we will do it. As we see things that will benefit both our residents and our investors, we will do it. And finding different vehicles to make that happen has been core to that. And an example of that is the fact that we've created this fund in part to be RSP eligible. So we had so many folks investing directly into our LP structures, which has been the bread and butter for the last 7 years, saying, hey, we want to put part of our TFSA or our RSP into this type of product as well. That was part of how and why the mutual fund trust was born. So with that in mind, we're going to continue to evolve the business and create new ways to make money for our investors.
I like it. So just to confirm that, because it was one of the questions from the Q&A box, RSP, TFSA eligible for the fund?
RIF eligible, yes. Yeah.
Excellent. So that covers off that one then. Thinking about kind of the presentation our investors and our advisors have seen today, and it's, I think I mentioned at the beginning, it's amazing how fast time flies, and we've got a minute or two left. Maybe Doug and Mark, ask each of you just for a quick parting thought, something that we either didn't cover, something that perhaps we missed, or something that an investor or an advisor may not know about you and the firm, your mission. Maybe Doug, start with you, something that you'd like to share as a parting word.
Yeah, no, I think the biggest thing is I look at real estate going forward, and the biggest impact it will have to your investments in real estate goes back to your dishwasher. It really pay attention to inflation, pay attention to the impact on real estate, pay attention to supply. That's the other gap that I manage, and it's understanding where the supply is in the markets you're investing in. So Phoenix, they're going to be short around 3,000 units next year. Texas and Dallas, they're going to be short 6,000 units per our estimations in Dallas, and even greater in Houston. Houston's a market that, although oil is coming back in a hurried way, it's been a market that's been left somewhat unfettered. So everyone has been scared to go in, and you're going to see some movement in that market going forward, given that supply is all but stopped. And it may be stopped because they can't find a dishwasher or something else, but it has, that pause is going to have a massive impact on real estate. And that perhaps, if any word is my parting word, that would be the one that I would suggest.
Noted. And thank you for that. Mark, over to you.
I guess at the end of the day, advisors in particular, where I've spent most of my career working with these folks, they're always looking for the best for their clients, and they're looking for well-rounded portfolios with solid risk management and a solid upside. At the end of the day, that's exactly what we do. And, we want to partner with advisors and, ultimately their clients to help them achieve their financial goals, and in a way that our neighboring competitors are not. So it's not a you or, it's a you and. So to be part of that conversation with advisors, I think, is really important for us. When the co-founders, Janet and Dave, approached me about joining the firm, one of the first comments I made to them is, you're one of the biggest companies that I haven't heard much about before. And we're now very much getting on that radar. A lot of advisors know about us. A lot of dealers know about us. So integrating us into what they do is just going to make a lot of sense on a go forward. So we're here to partner with you individually, and make sure that your clients are winning in the end.
I like it. And partner is a key word for us. It's something that we firmly believe in. It's how we bring all of these terrific financial solutions together and access the dealer and investment community through partners. Mark and Doug, I really appreciate you both taking time out over your, maybe not lunch, since it's a bit earlier for you, but your late morning, to spend a bit of time with us here at Deal Square and NEO, and talk a bit about Western Wealth Capital for our crowd. Reminder for our audience, WWC US is the ticker for their mandate, and I'm 100% confident, and Mark and Doug look to you for a nod, that if you have any questions at all about the mandate, their capabilities, operational history, track record, or just curious to learn a bit more about the firm in additional detail in a one-on-one format, confident they'd both happily take a connection and a reach out to share a bit more about themselves and their capabilities. So, to our audience, thank you very much for joining us. Mark, Doug, I certainly appreciate you taking the time out. Look forward to further conversations in the days and weeks ahead. To our audience, this is Neo and Western Wealth Capital signing off.